Oh, hello. Welcome. You're a little early. As you can see, I just got out of the shower, but why don't you come on in? We'll talk about technical analysis today. Welcome to my hotel room. I'm obviously in my robe, just to be comfortable. Hopefully not too creepy. This is the bed I rented, and here's the screen where I play my specialty movies, which we don't need to worry about that today. So we're going to be talking only about technical analysis, and I promise when we do that, I will be fully clothed. I promise we're going to keep it rated G, so I hope you enjoy what you see. Let me get dressed and then we'll talk technical analysis. I promise to remain clothed for the remainder of this episode at least. For future episodes, I promise nothing. Anyway, today we're going to be talking about something called technical analysis. And when we talk about investing in general, the world gets broken down into two camps. We at Capital Rev engage in one of those camps mostly, something called fundamental analysis. And with fundamental analysis, what you do when you analyze a stock, for example, you look at the economic fundamentals of that company as much as you can. So you look at the financial statements, you look at whether the company itself or its customers or suppliers have relative buying power, who's dominant in the relationship, and so on. The other camp is what I'm going to be talking about today, called technical analysis. And in technical analysis, in its purest form, a technical analyst will eschew all that stuff or just ignore all that stuff about the so-called fundamentals of a company and look at past price patterns in order to predict future price patterns. And so just like fundamental analysis has the risk of the false narrative, and we talk a lot about false narrative on this channel, technical analysis has the risk of the false pattern recognition. Nothing's perfect. Nothing's the perfect silver bullet that's going to cure all of your ills. So the next question, of course, is what do we do? I'm going to be going through a bit of a critique of technical analysis today. I'm not willing to say that it's junk, but I do want to make a note that people should be cautious when they use it. So I'm going to be looking at criticisms of it first, and then we're going to go through a bit of an exercise looking at two very common companies. The first problem with technical analysis, and I'd say it's a problem with all forms of analysis, is something called confirmation bias. We have a view of how the world works or what's going to happen in the future. So for example, with technical analysis, if you have a belief about a stock's direction, that belief is going to overshadow real, honest, objective analysis of what's actually happening in terms of volume or price patterns or whatever else you look at. We sort of decide that every bit of evidence we get or every bit of evidence that we're exposed to confirms what we already believe. So confirmation bias for technical analysts is a real problem. The second problem with technical analysis is one particular to it, and that problem is what I call but I saw it in a really cool book on technical analysis and it seems to prove the theory. When an author writes about technical analysis, because they're limited to space, they are forced into something called sample selection bias, which means they comb through reams of data, years of data, to find chart patterns that confirm that the system that they're employing or that they're talking about actually works. And in the times they talk about, the system actually did work. The problem is, from our perspective today and in the future, is there's about 12,000 stocks that trade in North America at any given time, and so the analyst or the author of that book can't tell us the times when the system that they employ predicted a zig and the market actually zagged, or vice versa. So there's a belief that we have too much faith in technical analysis because we read a book and that book says that everything every time, or implies that every time we use this system it works for us, and that's actually not the case. The next problem with technical analysis is something I call the Rorschach Problem. I hope I'm pronouncing that right. And that problem is that basically two technical analysts can look at the same chart, look at the same data, and come to two different interpretations of it. There's lots of different ways to slice and dice a stock chart, and it's possible much of the time to come to very different views about what's going to happen with a stock given the same amount of data. So it's open to huge amounts of interpretation, just like all forms of analysis, and that's something specific that you want to be mindful of if you use technical analysis, this thing I call the Rorschach Problem. Now, a system I've not heard in literature, but one I've come up with myself, is something called coefficient instability. Now, coefficient instability is a fancy way of saying that regimes and economic systems change, and so history is only so relevant, is basically the message. So think about the following idea. The market before the so-called Greenspan put in the in the 1990s, and after the Greenspan put, those were two, in a sense, different markets, and so stocks behaved differently, and the supply-demand characteristics of stocks were different when everybody sort of quote-unquote knew that the Alan Greenspan, the central banker, was going to offer people a kind of put, a floor below which stocks wouldn't go. Or think of another example. People's risk appetite and their demand for stocks before the dot-com bubble exploded was much different than their demand for stocks after the dot-com bubble. There's a fundamental belief in technical analysis that history is relevant, and it turns out that it actually may not be as relevant as we think it is. And so a chartist has a real problem. They have the following problem. They've got to make a choice between statistical relevance, i.e. they need to pick data that is only relevant to the domain that they're living in at the moment, or statistical reliability, which means that they want to take a lot of data, and so it's a really, really tough conundrum for technical analysts to work through. And I haven't actually come across any really good research on this, or any technical analyst who actually addresses this issue, and I think it's a huge one. So that's the Doyle criticism, if I could name it after myself. And it's one that no real chartist has dealt with, in my opinion, yet. Coefficient instability. Look it up. It's actually kind of a fun idea. Maybe not a fun idea, kind of a geeky idea, but an interesting one. So the next problem with technical analysis, and I'll be demonstrating this one today actually, is that rules are hard and fixed until they're not. The fact of the matter is rules apply more to some securities than others. Different securities have different idiosyncrasies attached to them, and so we can't apply a hard, fast rule across all stocks all the time. Certain stocks are going to be more heavily influenced by the behavior of certain institutional investors or analysts and so on, and so applying a blueprint to how the world works actually is a bit of a naive and dangerous perspective. The other problem is that a lot of the rules, the hard, fast rules, don't actually work over time, and we don't have any real sense when we read stuff put out by technical analysts, or chartists as they're sometimes called, how frequently the system breaks down. And because we don't know how frequently the system breaks down, we don't know what the success-failure rate is, we have no real basis for making sound sort of investment decisions, right? If I don't know if I have no idea of whether this system breaks down 80% of the time or only 20% of the time, I have no real way to put real money to work or know what my real risk is, and that's a sort of scary thing. So today, what I'm going to be looking at is two sort of tools that technical analysts use. One's called Japanese candlesticks, and the other's called relative strength index. I'll be looking at Microsoft stock and Johnson & Johnson and pointing out how using candlesticks and relative strength index would have led to very, very unprofitable trades on two occasions that I just sort of picked off the top of my head. So if it is that easy to find times when the system breaks down, it's quite possible that the system's not as robust as we think it might be.